Welcome to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into the environmental services sector, comparing the industry giants, Tetra Tech and Onterris.
Right.
Tetra Tech is executing as a cycle-resistant, backlog-driven compounder, providing infrastructure stability. Conversely, Onterris is in a high-leverage transition, integrating its platform to capture high-margin, industrial regulatory demand.
Yeah, and it really is, it's honestly a masterclass in how two different companies can look at the exact same macro environment, the exact same global transition, and deploy completely divergent, highly specialized strategies to capture that value.
Exactly. And, well, that is exactly what we are here to figure out today. We are acting as your financial forensics team for this deep dive.
Mm-hmm.
Our mission is to really examine these two companies, not just as, like, generic green stocks, which is honestly how a lot of the market casually treats them, right?
Yeah, completely.
But to look at them as distinctly different capital allocation vehicles. So whether you are prepping for a high-stakes investment committee meeting this week, or you are managing your own personal portfolio and you're just looking for long-term compounders, understanding the structural fundamental differences between Tetra Tech and Onterris is absolutely paramount.
It is.
You cannot just throw a dart at the environmental sector and hope for the best here.
You really can't. I mean, the nuances dictate the returns.
Right. Now, before we get into the heavy financial plumbing, the backlogs and balance sheets, I want you, the listener, to just imagine a scenario for a second.
Okay.
Imagine you are running a massive, multi-billion-dollar industrial manufacturing plant. You got an expansion planned, you're looking to refinance some debt, and you go to your banking syndicate.
Right.
But suddenly, your access to that capital is just cut off, or the interest rate quoted to you is completely punitive. Right. And why? Because you couldn't definitively, mathematically prove to your lenders and regulators that the soil beneath your plant, or, the wastewater exiting your facility, is free of newly regulated contaminants. That is the new reality.
It is. And it's a perfect framing, honestly. It really sets up the macro context that we have to understand before we even start analyzing these specific stocks.
Mm-hmm.
Because we are currently living through what industry analysts are calling the Great Environmental Reset.
The reset.
Yeah, exactly. For decades, environmental stewardship, so things like minimizing emissions, treating wastewater, cleaning up contaminated soil, that was largely viewed by the corporate world as basically a discretionary PR expense.
Oh, absolutely. It was a line item under marketing. Look at us. We're saving the turtles.
Exactly. It was something you did to look good on a corporate social responsibility brochure right next to photos of, employees planting trees on Earth Day.
Right. But that era is completely over now.
Completely over. Today, environmental compliance is a mandatory data-driven reality. And just like your scenario perfectly illustrated, it dictates access to capital.
Yeah.
If a massive industrial manufacturer cannot prove its environmental risk is managed, its cost of capital just spikes. Private equity firms won't acquire them without a flawless environmental phase 1 assessment.
Banks won't lend to them.
Right, and insurance companies will literally price their premiums out of existence. So, environmental compliance is now a non-discretionary operating expense. It is a must-have, not a nice-to-have.
So it's basically about cold, hard financial survival for these clients. It's risk management at its most elemental level.
Precisely. And that shift, that mandate, has created a massive secular tailwind for the companies that provide these services. But as we are about to see, securing the revenue from that massive boom looks completely different depending on whether you are Tetra Tech or Onterris.
Okay, let's unpack this. Starting with the first major piece of evidence in our financial forensics audit. How these companies actually secure and forecast their revenue. Because we are looking at the fundamental divide in their business models. On one side, we have the backlog, and on the other, the pipeline.
Oh.
So, let's start with Tetra Tech's staggering fortress of a balance sheet.
Let's do it.
At the end of the second quarter of fiscal 2026, Tetra Tech reported a multi-year backlog of $4.28 billion.
Oh.
That is billion with a B, and that was an 8% sequential increase.
And we really need to pause and just appreciate what that number represents in the physical world. Because a $4.28 billion backlog, it isn't just a vanity metric you put on a slide deck to appease Wall Street analysts. It is a structural recessionary buffer.
Right.
Tetra Tech operates as the lead consultant on massive multi-billion-dollar capital projects. We are talking about global infrastructure here.
Yeah.
And because they are doing the front-end consulting for long-term sustainable reliable infrastructure, their revenue is highly, highly insulated from short-term macroeconomic volatility.
Okay, define front-end consulting for us here. Like, what are they actually doing day to day?
Sure. They are the ones doing the initial feasibility studies, the master planning, the complex engineering designs, and the regulatory permitting before a single shovel even hits the dirt.
Okay.
They are planning projects that will take a decade to build. So think about a massive coastal resilience project to protect a city from rising sea levels.
Right.
That requires years of modeling, environmental impact studies, and, design iterations. Tetra Tech handles all of that.
Okay, but let me push back on that for a second.
Sure.
Because we hear the word backlog thrown around all the time as if it's, cash sitting in a vault.
Yeah.
But a contract is just paper until the cash actually clears.
True.
If we enter a severe macroeconomic downturn, say interest rates spike to 8%, and municipal bond markets just freeze up, don't these massive infrastructure projects just get delayed or canceled?
Well,
I mean, is a backlog really bulletproof? Look at the recent debt ceiling standoffs in Congress. Funding gets frozen all the time.
it is a critical distinction to make, and you are absolutely right to challenge the idea of a bulletproof backlog. Nothing is entirely immune to macroeconomic shocks.
Right.
If the federal government actually defaults, or if, like you said, a severe liquidity crisis freezes the municipal bond market entirely, you would absolutely see delays in cash conversion.
Yeah.
However, you have to look at the specific mechanics of how these funds are appropriated and who the clients actually are.
Okay, walk me through those mechanics then.
So a massive portion of this $4.28 billion is tied to high credit quality government, defense, and large-scale municipal clients.
Mm-hmm.
The funding for these projects isn't drawn from, like, a quarterly discretionary budget that gets slashed the moment a recession hits.
Okay.
These are structurally funded, often appropriated years in advance by congressional acts like the Infrastructure Investment and Jobs Act, or through long-standing municipal bond measures that have already been raised. The cash is literally sitting in escrow.
Oh, I see. So it's not like a corporation deciding to just delay buying new laptops for a year because earnings were soft.
Exactly.
The money is literally legally earmarked for the project and cannot be spent on anything else.
Precisely. So while a temporary government shutdown might delay an invoice payment by 45 days or so, the project itself isn't canceled. The revenue is recognized.
Okay, I see. So to put an analogy on it, Tetra Tech is like the master architect of a skyscraper.
Yeah, that's a good way to put it.
Right. Once the blueprints are drawn, the massive construction contract is signed, and the municipal funding is fully appropriated, and just sitting in an escrow account, that project is moving forward.
It has to.
It doesn't matter if consumer spending drops a point next month or if we have a mild recession. The architect is getting paid to oversee the build because the capital is already locked in place for that specific purpose.
That is an excellent way to conceptualize it. Tetra Tech's visibility into their future revenue is crystal clear because the contracts are long-term, structurally funded, and frankly, they're just too big to fail once they're in motion.
Mm-hmm.
Right. You cannot leave a half-built dam or a half-finished naval base modernization project just sitting there. The physical reality demands completion.
Yeah, that makes perfect sense. Okay, now let's pivot and contrast that massive architectural fortress with Onterris.
Okay.
And just a quick note for you listening. If you are looking at your terminal right now and trying to find Montrose Environmental Group or ticker MEG, you need to update your charts.
Yeah, definitely.
They rebranded to Onterris, ticker ONT, in April of 2026. Same company, new operational structure, which we'll get into. But Onterris operates on a totally different wavelength regarding revenue visibility.
You do.
They do not rely on a multi-billion-dollar, decade-long backlog. Instead, they guide Wall Street based on what they call a project pipeline.
And what's fascinating here is how that pipeline model exposes them to short cycle risks that Tetra Tech simply doesn't feel.
Right.
A pipeline is dynamic. It is a measurement of highly probable near-term work, but it hasn't necessarily been formalized into a multi-year locked-in contract vehicle.
Right, and that dynamic nature means they are exposed to the physical elements, which we actually just saw play out recently.
Oh, I did?
In the first quarter of 2026, Onterris actually had a revenue miss. They brought in $168.5 million, which was a decrease from the prior year. Yet, surprisingly, management maintained their full-year fiscal 2026 guidance of $840 million to $900 million.
Yeah.
Now, as an investor, if I see a company miss Q1 by a decent margin and they come out and say, don't worry, we're still going to hit our annual target, my immediate reaction is, extreme skepticism.
Sure.
How do you miss Q1 and confidently tell the market nothing has changed?
Well, to understand their confidence, you have to look away from the spreadsheet for a second and look at the physical reality of what Onterris does on a random Tuesday morning.
Okay.
They are a field-to-lab business.
Explain the physical mechanics of that. What does field to lab actually mean?
It means they have technicians physically driving trucks, going out to industrial sites, refineries, chemical plants, and municipal water sources. They put on protective gear, they take highly specific, highly regulated soil, air, and water samples. They establish a legal chain of custody for those samples, put them in climate-controlled transport, and physically drive them back to an Onterris-owned laboratory.
Okay.
Then the lab runs complex mass spectrometry on the samples to check for contaminants, and then Onterris generates a legally defensible report for the client to hand over to the EPA.
So that is a very labor-intensive physical process.
That is extremely physical.
Yeah.
And in Q1 2026, North America experienced unseasonably severe, persistent winter weather.
Oh, right.
We are talking about deep freezes, blizzards, and prolonged ice events across key operational regions.
Yeah.
So this wasn't a macroeconomic issue where clients canceled contracts. It was purely a physical logistics issue. The weather literally prevented their field teams from driving out to these industrial sites to take the samples.
Wow.
If the ground is frozen solid under 2 feet of ice, you just can't take an accurate soil sample.
Right.
And if you can't take the samples, you can't transport them to the labs.
Right.
If the labs aren't processing samples, you aren't billing revenue. The entire physical chain just stops.
So the technicians were literally snowed in. It's that simple.
It really is that simple.
Right.
Furthermore, their high-margin environmental emergency response segment saw a significant drop as well.
Okay, let's break that down. What constitutes an environmental emergency response for Onterris?
Think of a freight train derailment carrying hazardous chemicals, a localized pipeline leak, or an industrial fire that results in toxic runoff.
Okay.
When those unpredictable events happen, the responsible party is legally mandated to immediately deploy an emergency assessment team to measure the scope of the contamination and begin remediation planning.
Mm-hmm.
Onterris is the team they call. They have rapid response units on standby.
I see. And because it's an emergency, it obviously commands a premium margin.
Mm.
You don't negotiate price when toxic chemicals are spilling into a local river. You just say, get here right now.
Exactly. It is highly lucrative, but it is inherently episodic. You cannot predict when a chemical spill or a localized contamination event is going to happen.
Right.
In Q1 of 2025, they generated $14 million from these emergency responses. It was just a busy quarter for accidents. But in Q1 of 2026, it was a quiet quarter, and that revenue dropped to $8 million.
Okay, which
Yeah.
perfectly explains the revenue miss.
Yeah.
But it still begs the question of why they held their annual guidance firm. If you lose that emergency response revenue in January, isn't it just gone? You can't ask a train to derail in June to make up for a quiet January?
You're right about the emergency response piece. You definitely can't force that. But the emergency response is only one piece of the puzzle.
Okay.
The crucial distinction for the rest of Onterris' business, so the core testing and consulting, is that this was a timing issue, not a demand issue.
Right, because of the regulations.
Exactly. Because of the non-discretionary nature of environmental compliance we talked about earlier, these clients don't just get to cancel their air quality or soil testing because it snowed. The EPA still requires the data by a certain deadline.
So they just do it later.
Exactly. Management explicitly detailed that about $50 million in total revenue simply shifted from the first half of the year to the second half.
Let me guess. They broke that $50 million down for the analysts to prove it.
They absolutely had to, or the market would have punished them even more.
Right.
It was roughly $25 million in consulting revenue, $15 million in emergency response that they statistically expect to normalize during the historically busier Q3 and Q4 seasons based on their run rates, and $10 million in mandatory testing.
Okay.
The work wasn't lost to a competitor. The client didn't go out of business. The factory still has to prove its emissions are legal. They just have to prove it in June when the ground thaws instead of February. Regulatory compliance is mandatory, not optional.
Right. It's basically deferred revenue just waiting to be realized. So understanding how these two companies get paid, Tetra Tech's decade-long structurally funded backlog versus Onterris's agile weather-sensitive pipeline, it naturally leads us to examine who exactly is paying them. Because if you're holding these stocks, the creditworthiness of the end client is everything.
Absolutely. And while both companies deal heavily with government entities, they do so in completely opposite ways.
Let's do some government integration forensics here then.
Okay.
Tetra Tech is basically a mission-critical prime contractor.
Yeah.
We are looking at roughly 47% of their total revenue coming from government contracts.
Massive.
It's a massive footprint. They break that down as 30% for the federal government and 17% from state and local governments.
All right.
Now, the source material notes, they utilize these massive alphabet soup contract vehicles like Oasis Plus and GSA schedules.
Yeah.
They literally boast a $30 billion U.S. federal contract capacity. For a listener who doesn't work in federal procurement, what does Oasis Plus actually mean, and why is a $30 billion capacity considered a competitive moat?
It is a phenomenal moat, honestly. So Oasis Plus stands for One Acquisition Solution for Integrated Services Plus.
Okay.
It is what the government calls a best-in-class, multiple award contract vehicle. Essentially, the federal government doesn't want to go through a massive, years-long bidding process every single time they need a complex engineering or consulting job done.
Right, that would take forever.
Exactly. So they pre-vet a highly select group of top-tier contractors, proving their financial stability, their security clearances, and their technical expertise.
Oh, so it's like getting a VIP black card for federal spending.
That's a great way to think about it. Once you are on the Oasis Plus vehicle, you have a hunting license. You are allowed to bid on specific task orders that companies outside the vehicle cannot even see, let alone bid on. The barrier to entry to even get on that list is incredibly high, and that $30 billion capacity isn't guaranteed money. It's the ceiling of what the government is allowed to spend through those specific vehicles with Tetra Tech over a given period.
Yeah.
It just signifies the immense scale of trust the government has in them.
So what does it actually mean to be a prime contractor at that scale? Like, what are they doing with that hunting license?
It means you are the backbone partner for the government. Tetra Tech isn't just fulfilling a small, isolated task order. They are integrating entire missions for the Department of Defense, the DoD, and the U.S. Army Corps of Engineers, or USCE.
Okay.
We are talking about designing resilient infrastructure on a massive systemic scale.
Give me a concrete example. What does a resilient infrastructure project for the Army Corps of Engineers actually look like on the ground?
Let's look at Coastal Naval Facility.
Okay.
The U.S. Navy has massive, multi-billion-dollar shipyards and bases on the coastlines. Those facilities are facing the physical reality of rising sea levels, more intense hurricane storm surges, and aging 1950s infrastructure. Right.
If a base floods, the Navy's operational readiness is compromised. That is a national security issue.
Absolutely.
So the DoD will hire Tetra Tech as the prime contractor to design a comprehensive master plan. Tetra Tech will model the hydrology of the entire region, design specialized seawalls, re-engineer the base's internal drainage and pump systems, and ensure the modernized dry docks can withstand a Category 5 hurricane while maintaining environmental compliance for the surrounding marine ecosystem.
That is just incredible scale.
It really is. They are deeply structurally embedded in the federal spending cycle because they are engineering the survival of the nation's critical assets.
Wow. Meanwhile, Onterris's government exposure looks completely different.
It does.
They aren't building naval bases or engineering massive inland navigation systems. They are out there in the mud cleaning up toxic sites.
Correct. If Tetra Tech is the strategic general, Onterris acts as the tactical specialist. Onterris relies on highly specific, localized task orders, primarily from the Environmental Protection Agency, the EPA, and the Department of the Army. Let's use the analogy from the critique earlier because I think it works perfectly here. It's the difference between going to a general hospital versus a highly specialized clinic.
Yes.
Tetra Tech is building the hospital. But if you have a very specific, localized hazardous issue, you call the specialist.
Exactly right. Let's say the EPA identifies a legacy industrial site, maybe an old chemical manufacturing plant from the 1970s that was just abandoned.
Okay.
The soil is contaminated with heavy metals, and it's threatening the local groundwater supply. The EPA doesn't need a master architect. They need a tactical extraction team.
Right.
So they issue a task order to Onterris. Onterris deploys their field technicians, they drill the soil cores, they map the exact underground plume of the contamination using their labs, and then they execute the specific hazardous substance remediation.
They just get in there and do it.
Yeah, they dig it out, treat it, and monitor the site to ensure rigorous compliance with federal hazardous waste standards. It is specialized, task-specific, and highly tactical.
Okay. Now, whenever we talk about government contracts, especially at this scale, we have to talk about the elephant in the room. Political volatility.
Oh, yeah.
We are looking at an environment where presidential administrations change every 4 to 8 years, federal budgets get slashed, gridlocked, or reallocated, and political ideologies swing wildly back and forth.
Always.
If you were an investor looking at a company where 47% of its revenue comes from the government, like Tetra Tech, or relies heavily on EPA task orders like Onterris, how do you model for political risk? Does a change in power blow up the thesis?
It is the most common question investors ask about this space. But if we connect this to the bigger picture, we have to look at what analysts call the political realism of the environmental sector.
Right, let's get this strictly impartial and just look at the actual mechanics of the spending and the engineering.
Exactly. It is very easy to fall into the trap of reading headlines and thinking that green stocks only thrive under certain political administrations and get crushed under others, but that completely ignores the physical reality of the work being done here.
Walk me through that mechanics part.
The mechanics show that this work is largely non-discretionary, regardless of who occupies the Oval Office. Take Tetra Tech. Maintaining aging dams before they collapse and wipe out a downstream town, upgrading defense facilities so the military can actually launch ships, ensuring municipal water systems don't poison residents. These are not ideological projects.
No, they're basic survival.
Right. They are essential civil works. Regardless of who is setting the federal budget or what their platform is, a failing dam has to be fixed. The military has to be operational. Gravity and hydrology do not care about political affiliation.
The plumbing of the nation has to work. If you turn on the tap and brown water comes out, you don't care about the politics. You just demand the city fixes it.
Yeah.
And the city calls Tetra Tech.
Precisely. And the exact same logic applies to Onterris, just on a different vector. Onterris's growth is driven by the complexity of regulations, not necessarily the ideology of the administration.
Explain that. Because conventional wisdom says deregulation hurts environmental companies.
It's a misconception in this specific niche. Even in periods of massive federal deregulation, industrial clients still have complex legacy compliance issues to deal with. Just because a new rule isn't passed doesn't mean the old rules vanish overnight.
That's true.
Furthermore, when federal regulations loosen, we historically see state-level environmental agencies tighten their own regulations to compensate.
Oh, interesting.
So if you are a multinational corporation operating in 30 different states, dealing with 30 different sets of complex, shifting state regulations is a nightmare.
Yeah, you need a guide.
Exactly. You don't fire your compliance consultant when regulations get confusing. You rely on them more. Both Tetra Tech and Onterris act as the essential plumbing of the infrastructure and compliance world. They are relatively insulated from partisan shifts because the problems they solve are physical realities, not political theories.
Okay, so they've both secured massive, albeit different, revenue streams from highly reliable, legally mandated clients. They're both doing essential work. But revenue is vanity. Profit is sanity, right? It doesn't matter if you have a $4 billion backlog if you run the business so poorly that you lose money on every contract.
Right.
So how efficiently are they turning those top-line revenues into actual bottom-line profit? Let's look under the hood at their operational efficiency and margin mechanics, starting again with Tetra Tech. In Q2 of 2026, they achieved a record EBITDA of $146 million.
And let me just quickly define EBITDA for anyone who might be newer to financial forensics.
Good idea.
It stands for earnings before interest, taxes, depreciation, and amortization. It is essentially a proxy for the raw operational cash flow of the business, stripping out all the accounting and financing noise.
Right.
Hitting $146 million in a single quarter is a testament to massive operational scale.
And crucially, the sources note they expanded their margins by 90 basis points year over year.
Yeah.
Again, for clarity, 90 basis points is 0.9%, which, might sound small to someone used to software margins, but in the heavy infrastructure world, almost a full percentage point of margin expansion on billions in revenue is serious operational leverage.
It is huge.
How are they squeezing more profit out of every dollar?
It comes down to a very deliberate, calculated shift in their contract strategy. Over the last few years, Tetra Tech has been actively pivoting toward higher margin, fixed price contracts.
Well, let's do a deep dive into the mechanics of that. Explain the difference between cost plus and fixed price contracts for someone who might not be familiar with federal contracting structures, because this really seems to be the engine of their profitability.
Absolutely. Generally in this space, you have two main types of contracts: cost plus and fixed price.
Okay.
Let's use a home renovation analogy.
Always helpful.
If you hire a contractor on a cost-plus basis to remodel your kitchen, you agree to pay for all the materials, the wood, the nails, the tiles, plus all the hourly labor, plus a guaranteed 10% profit margin on top for the contractor.
Right, so if it takes him 3 weeks longer than expected, I just have to keep paying the hourly rate.
Exactly.
It's safe for the contractor because he can never lose money.
Yeah.
But his upside is capped at that 10% fee.
Exactly. And the government loves cost plus for experimental or highly uncertain projects because it shares the risk.
Okay.
A fixed price contract, on the other hand, means the contractor looks at the kitchen and says, I will do the entire remodel for exactly $50,000, period.
Right.
If it ends up costing the contractor $60,000 in labor and materials, he eats the $10,000 loss. But if he is incredibly efficient and gets it done for $30,000, he just made a $20,000 profit, which is a massive margin.
Which sounds inherently riskier.
It can be.
If you are Tetra Tech and you sign a fixed price contract to build a massive water treatment facility over 3 years, what happens if the price of steel spikes 40%? Or labor costs surge? Don't you blow up your margin entirely? How do they not cut corners or lose their shirts?
Well, it is riskier if you don't know what you are doing or if you don't have scale. But Tetra Tech mitigates that risk through decades of proprietary data and advanced engineering modeling.
So they have a crystal ball.
Basically. They aren't guessing. They have deep historical data on supply chain costs, labor rates, and physical engineering challenges. They know exactly how to model these projects down to the bolt.
Wow.
Furthermore, they build in complex escalation clauses for commodities like steel. Because they can execute highly efficiently using proprietary software and experienced teams, they keep all the savings as pure profit.
That makes sense.
And these fixed-price contracts now make up 48% of their net revenue, up from 37% in just 2023.
So they are effectively betting on their own competence.
Yes.
They're saying, we are so much better at this than anyone else. We don't need the safety net of a cost-plus contract. Gives the fixed price, and we'll keep the efficiency gains.
Exactly.
And it's paying off in that 90 basis point margin expansion.
Yes. And it does something else incredibly important on the balance sheet, too. It drastically lowers their working capital intensity.
How so?
Under a cost-plus contract, you often have to incur the costs first, submit a massive audited invoice to the government proving every single expense, and then wait for them to pay you back.
Which takes forever.
Exactly. It ties up your cash. When you execute efficiently on fixed-price contracts, you often negotiate milestone payments. As soon as you hit a milestone, you bill a set amount.
Oh, that's much better.
You can bill and collect cash much faster. This is directly evidenced by Tetra Tech's impressive 58-day DSO, or days sales outstanding.
58 days from the moment they issue an invoice to the moment the cash is sitting in their bank account on massive government and municipal projects. Having dealt with government bureaucracy myself, getting paid in under 2 months is a tight ship.
It is an exceptional cash conversion cycle for the infrastructure space. It means they are incredibly disciplined operators.
Okay, let's flip back to Onterris. Here's where it gets really interesting.
Let's hear it.
We established earlier that Onterris actually missed their Q1 revenue target because of the winter weather physically stopping their operations.
Right.
Yet, if you look at the bottom line of the income statement, their adjusted EBITDA was $17.8 million, and their margin hit 10.6%.
Yeah.
They actually beat profit expectations on a revenue miss. How do you pull that off? Usually when revenue drops, margins collapse because you still have fixed overhead to pay.
This is where we see the strategic genius of their April 2026 rebrand.
Okay.
As we noted, they changed their name from Montrose to Onterris. But we need to make it incredibly clear. This wasn't just a marketing exercise.
It wasn't just a new logo.
No, it wasn't just a new logo and a new font on their website. It was a fundamental, grueling operational realignment of their entire corporate structure.
What did they actually change internally? Walk me through the physical reality of the reorganization.
So previously, when they were Montrose, they operated through growth by acquisition, which left them somewhat siloed. They had an assessment, permitting, and response segment. So the people who tested the soil, and a separate remediation and reuse segment, the people who actually dug up the soil and fixed the problem, they were distinct units. When they rebranded to Onterris, they ripped down the walls and merged those two distinct units into a single, unified consulting and treatment segment.
Why does merging segments increase profit margins so dramatically, though?
Because it ends what we call cross-selling friction and duplicative overhead.
Explain that.
Let's look at the physical reality. Before, if a client hired them for a localized assessment, the assessment team would drive a truck out there, use their specific software to log the data, and bill the client.
Right.
If they found contamination, bringing in the remediation team felt like handing the client off to a completely different company. They had to send a second truck, use a second software system, and go through a second billing department.
So they were doubling up on administrative and logistical costs for the exact same client on the exact same plot of land.
Exactly. By unifying the platform, they seamlessly move from testing the problem to engineering the treatment. It's one point of contact, one integrated software backend, and one cohesive team.
Wow, that's smart.
You put one team in one truck, instantly having your travel and administrative overhead. Combine that structural efficiency with their divestiture of a lower-margin renewables business in 2025, which dragged down their overall profitability, and you get incredible cost discipline.
Yeah.
In that newly merged consulting and treatment segment, they achieved a massive 370 basis point margin expansion in Q1.
370 basis points. That's almost a 4% increase in profitability, even with revenue down because of the snowstorms.
It is huge.
That mathematically proved they have fundamentally lowered their break-even point. They are squeezing way more blood from the stone.
Exactly. It proves that the integrated platform model works. When that deferred $50 million in revenue we talked about earlier comes back online in the second half of the year, it is going to flow through a much more efficient, highly profitable system. The operational leverage going into the second half of 2026 is massive.
Okay, so to sustain these kinds of margins, whether it's Tetra Tech's fixed price execution or Onterris' newly integrated platform, a company needs a moat. You can't just have high margins in a vacuum in a capital system. If you do, competitors will see your profits, rush in, underbid you, and crush your margins.
Always.
In the environmental services sector, that moat isn't built on brand loyalty. It's built on proprietary technology and regulatory tailwinds. And there is no bigger regulatory tailwind right now across the entire globe than the massive issue of PFAS.
PFAS, per and polyfluoroalkyl substances, almost universally known as forever chemicals.
Right.
I cannot overstate this. PFAS is arguably the defining environmental compliance issue of this decade and likely the next.
Let's do a quick science sidebar for the listener. What physically are these chemicals and why are they suddenly causing a global panic?
So PFAS are a class of thousands of synthetic chemicals used since the 1940s to make products resistant to heat, oil, stains, grease, and water.
Okay.
They are in non-stick cookware, water-repellent clothing, stain-resistant fabrics, cosmetics, and crucially, firefighting foams used extensively by the military and at commercial airports.
Wow, they're everywhere.
Yes, but the problem is the forever part. The carbon-fluorine bond is one of the strongest in organic chemistry. They literally do not break down in the environment.
Jeez.
They seep into the soil, they migrate into the groundwater, and they bioaccumulate in the human body.
And recent medical studies have linked them to a whole host of severe health issues, which has finally prompted the EPA and global regulators to drop the hammer.
Precisely. Regulators are now setting acceptable limits at parts per trillion levels.
Parts per trillion.
Yeah, to give you an analogy, 1 part per trillion is equivalent to 1 drop of water in 20 Olympic-sized swimming pools.
That is insane.
Detecting it is incredibly difficult. Removing it is a massive engineering challenge.
And both of these companies are attacking this exact same massive problem, but from entirely different, highly specialized angles. Let's look at Tetra Tech's proprietary scale first.
Okay.
They are managing massive, system-wide municipal water transformations to deal with PFAS.
Tetra Tech's Moat is their intellectual property, which they market under their leading with science approach.
Okay.
They aren't just giving municipalities a PDF report saying, hey, your water's contaminated. They are deploying proprietary physical technologies like their PFA scrub system.
Let's dig into the mechanics of that. What does PFA scrub actually do at a molecular level? How does it separate a forever chemical from millions of gallons of drinking water?
It's an advanced, multi-stage treatment technology designed to remove legacy PFAS contaminants on a macro scale. It typically involves a combination of highly specialized granular activated carbon filtration, advanced ion exchange resins, which basically act like molecular magnets to pull the PFAS compounds out of the water, and sometimes high-pressure reverse osmosis.
Wow.
The proprietary part is how Tetra Tech designs the sequence and integrates these systems to optimize flow rates and minimize the creation of toxic byproducts that then have to be disposed of.
Right.
They are deploying this for the U.S. Air Force, which has massive legacy issues with firefighting foams at air bases across the globe seeping into local town water supplies.
But they're also deploying it for major civilian municipalities. The source material specifically highlighted the Cypress Lake Alternative Water Supply Project in Florida. Walk us through that.
That is a perfect example of their scale. Florida has major population centers dealing with a dual crisis: saltwater intrusion into their aquifers due to sea level rise, and legacy contaminants like PFAS.
Oh man, a double whammy?
Yeah, you can't just dig a deeper well anymore. So Tetra Tech is designing these massive inland brackish groundwater desalination facilities.
Okay. They are engineering the intake systems, the high-pressure membrane filtration, and the deep well injection systems for the concentrated waste. They are the #1 ranked firm by Engineering News Record in U.S. environmental work because they have the proprietary tech and the engineering scale to clean water for an entire city.
That is awe-inspiring engineering. Now, contrast that massive citywide architecture with Onterris's approach to the exact same PFAS problem.
Completely different.
Onterris isn't building a desalination plant for the state of Florida. They are managing high-frequency testing for private sector industrial clients who are absolutely terrified of regulatory penalties from the EPA.
Right. Onterris's Moat is their integrated field-to-lab pipeline that we discussed earlier, applied specifically to emerging contaminants.
Okay.
When the EPA changes a reporting obligation for PFAS to parts per trillion, an industrial chemical plant or a regional landfill operator can't just guess if they are compliant. They can't rely on generic, outdated testing methods. They need legally defensible, mathematically flawless data. Because if the data is wrong, the fines are catastrophic or the plant gets shut down.
Exactly. Onterris's moat is that they control the entire data lifecycle. They don't farm out the testing to a third-party lab where the chain of custody could be challenged in court.
Ah, I see.
They send their own highly trained teams to collect the samples in the field using strict protocols. They test those samples in their own proprietary state-of-the-art mass spectrometry labs, and then they're consulting arm engineers the specific localized treatment plan based on that exact data.
The sources also noted they have a patent-pending system for methane, right? The Veriplume capture system.
Yes.
I want to bring this up because it highlights their technological moat beyond just PFAS. Why is testing for methane so difficult that you need a patent-pending system?
Methane is a massive focus for climate regulation, especially for the oil and gas industry.
Oh.
The problem with methane is that it's an invisible, odorless gas.
Right.
If a pipeline or a valve is leaking in the middle of a windy field in Texas, it is incredibly difficult to accurately measure the volume of the leak. Traditional methods involve technicians literally walking around with handheld sniffers, which is slow and wildly inaccurate.
So what does the Veriplume capture system do differently?
It's a proprietary hardware and software integration. It utilizes advanced laser spectrometry and drone-mounted sensors to actually capture, visualize, and precisely measure the volumetric flow rate of the methane plume in real time, regardless of wind conditions.
Oh, wow, drones and lasers.
Yeah, it provides the client with flawless, continuous data to hand over to regulators, proving exactly how much they are emitting, or, more importantly, proving that their leak repairs actually worked.
So to crystallize the difference for you listening, using that medical analogy again, if a major city needs a multi-billion-dollar water grid overhaul to filter out forever chemicals for 3 million residents, they hire Tetra Tech as the master architect to build the new hospital.
Yeah.
But if a specific industrial chemical plant needs to prove to the EPA tomorrow that their specific soil site isn't leaking forever chemicals into the local groundwater, or that their specific valve isn't leaking methane, they deploy Onterris as the agile, highly specialized clinic with the lab in the back room.
That is the perfect summary of their respective moats. Tetra Tech has the moat of massive scale, programmatic integration, and civil engineering dominance.
Right.
Onterris has the moat of specialized data dominance, rapid deployment, and owning the complete field-to-lab lifecycle.
All right, we understand their macro environments, we've broken down their operations, we understand their margin mechanics, and we see the physical science behind their moats.
Yeah, we've covered a lot.
Now for the ultimate financial forensic question. What are they actually doing with all the cash they generate, and how is the market currently valuing them? Let's dive into capital allocation and their respective value propositions for a shareholder. We're going to start with Tetra Tech.
Okay.
They are essentially acting as a cash-gushing compounder.
The numbers are staggering. In their latest filings, Tetra Tech generated $688 million in trailing 12-month, or TTM, operating cash flow.
$688 million in pure operational cash flow. That is a massive war chest for a company in the industrial services space. What is management doing with it? Are they hoarding it or are they deploying it?
They are acting exactly how you would want a mature, highly confident, defensive compounder to act. They are aggressively returning capital to shareholders.
Right.
They are consistently raising their dividend, and they are executing systematic stock buybacks, reducing the share count to increase the value of remaining shares.
Okay.
Simultaneously, they are using that cash flow to deleverage their balance sheet, paying down debt to maintain maximum financial flexibility in case interest rates stay higher for longer.
Okay, so they are behaving like a classic blue-chip value stock. They aren't chasing wild speculative growth. They are compounding wealth safely.
This raises an important question about valuation. If you look at the terminal, Tetra Tech is currently trading at a roughly 17.2x price to earnings, or PE ratio.
A 17.2 PE in a broader market that is currently obsessed with high multiple AI tech stocks trading at 40 or 50 times earnings seems almost quaint. It feels cheap.
It is a very reasonable valuation, especially when you look at their PEG ratio.
Explain the PEG ratio quickly for us.
PEG stands for price earnings to growth. You take the PE ratio and divide it by the company's expected earnings growth rate.
Okay.
A rule of thumb in value investing is that a PEG ratio around 1.0 means a stock is perfectly fairly valued for its growth. Tetra Tech has a PEG of 1.11.
So it's trading at a very fair, rational price.
Exactly. The market is pricing Tetra Tech as a reliable, defensive, value-quality stock. When you buy T-Tech at a 17 PE, you're not buying a lottery ticket.
No.
You are paying a fair price for a proven management track record, cycle-resistant cash flows, and a growing dividend that is supported by an ironclad $4.28 billion backlog. It is a sleep-well-at-night allocation.
Okay, so that's the value play. But Onterris, as we've established, operates on a totally different wavelength when it comes to capital allocation.
Entirely different.
They are not a dividend-paying value stock. You aren't buying them for quarterly income. They are a mid-cap, high-beta growth play.
Yes. Onterris' capital framework is almost entirely focused on reinvestment. Their primary goal is not returning cash to shareholders right now. They believe they can generate a higher return on invested capital by putting that money back into the business.
How are they deploying it?
They are heavily reinvesting into expanding their integrated technology platform, building out those proprietary labs, upgrading their Veriplume system, and crucially, they are executing selective, highly accretive tuck-in acquisitions. The environmental testing market is highly fragmented. There are hundreds of small local mom-and-pop testing labs across the country.
Oh, I see.
Onterris uses its capital to buy up the best regional labs, plug them into their highly efficient, centralized software and billing backend, and instantly expand their geographic and technical footprint.
Wait, but the sources noted a contradiction there. The data explicitly states they did buy back some stock in Q1 of 2026.
They did.
If they are a growth company that needs cash for M&A and labs, why are they spending cash to buy back their own stock? That's usually a mature company move.
It is a great catch, and it requires nuance to interpret. They utilized $10 million of a previously authorized $40 million share repurchase program, retiring about 376,000 shares in Q1.
Okay.
But that shouldn't be confused with Tetra Tech's massive programmatic capital return program. For Onterris, that buyback was a highly tactical signal to Wall Street.
A signaling mechanism. Explain that.
Remember that weather-related revenue miss in Q1 we discussed?
The snowstorms.
When that happened, the stock likely took a short-term hit as algorithmic traders reacted to the top-line miss. Management stepped in and bought $10 million worth of stock to signal to the market, we know this is just a weather delay.
Oh.
The $50 million is just shifted to the second half. At this suppressed price, our own stock is the highest return asset we can buy. They were signaling absolute confidence that the stock was trading below its intrinsic value.
A confidence play. Push your money where your mouth is?
Exactly. But their true north remains reaching consistent net profitability and establishing total data dominance in their niche. You can see this ambition in their new thought leadership initiative, the Onterris Outlook.
Oh, right. With the FT.
Yes, they just published this massive annual report in partnership with the Financial Times. It's designed to position their scientists and engineers as the premier thought leaders at the intersection of environmental compliance and business performance.
So they're building the brand.
Exactly. They aren't just trying to be a vendor. They want to be the definitive authority. They are playing aggressively for high-growth market share.
So what does this all mean? We've gathered all the evidence. We've audited the backlogs versus the pipelines. We've broken down the physical reality of their margin expansions. We've analyzed the science of their moats. And we've evaluated their completely different capital allocation strategies. It's time to synthesize all this data into an actionable final verdict for your portfolio. If I am looking to deploy capital in the environmental services sector tomorrow, how should I weight these two giants?
For capital allocators looking at this sector, the ideal strategy based on this forensic analysis is a barbell approach.
The barbell approach. Heavyweight on the two extreme ends, nothing in the murky middle. Walk us through the specific weight distribution for this sector. Why not just go 50-50?
Because the risk profiles are completely asymmetrical.
Okay.
On one side of the barbell, you have your core allocation. This should be roughly 70% to 80% of your total exposure to this sector. That core anchor belongs to Tetra Tech.
Right.
They are the unassailable infrastructure backbone. They are your best buy for core stability.
So that 70 to 80% is the sleep well at night money.
Exactly.
You are buying the $4.28 billion locked-in backlog, the highly disciplined fixed-price margin expansion, and the deep systemic integration into non-discretionary federal defense spending.
Exactly. It grounds the portfolio. And the other side of the barbell is the tactical allocation.
That is the remaining 20% to 30%. This is where Onterris comes in.
Correct. They are the agile compliance specialist. They are your best buy for tactical growth.
Okay.
You are sizing them smaller because the volatility is higher, but the upside potential is steeper. You are betting that their newly integrated, highly efficient platform will successfully capture the exploding, high-margin industrial regulatory demand as PFAS and methane regulations tighten globally.
It's a fantastic, rational framework. But as we know, and as we say at the start of every show, no investment is without risk.
None.
We define the risk before we look at the reward here. What are the primary execution risks that could break this thesis for either company? Let's start with Tetra Tech. What breaks the fortress?
For Tetra Tech, the primary execution risk is their sensitivity to long-term federal budget pacing and municipal credit markets.
Right.
While we established their contracts are stable, the rate at which new contracts are awarded and funded can drastically slow down during contentious federal budget cycles.
Right. If Congress can't pass a budget for 6 months and operates on continuing resolutions, no new mega projects get greenlit.
Exactly, but perhaps more pressing, management specifically noted in the source material that some of their local and municipal clients are anticipating potential reductions in supplemental federal grant funding.
Oh, interesting.
During the pandemic, the federal government showered states and cities with grant money for infrastructure. That money is drying up.
Which means the cities have to fund these massive water projects themselves.
Yes. And how do cities fund projects? They issue municipal bonds or they hike local water rates.
Neither of which are popular.
Exactly. If interest rates stay elevated, municipal borrowing becomes incredibly expensive. And local taxpayers generally revolt against massive utility rate hikes.
Yeah, they do.
If the municipal credit markets freeze, or if local voters reject bond measures, Tetra Tech's local revenue pipeline could face severe headwinds. The projects are needed, but the funding mechanism gets choked.
That is a very real, tangible risk to monitor on the macro level. And for Onterris, what's their Achilles heel? It clearly isn't municipal bond rates.
For Onterris, the execution risk is entirely internal. It is about proving that the narrative of their rebrand actually translates into sustained financial reality over the long term.
Okay.
They need to mathematically prove to Wall Street that their newly integrated consulting and treatment platform can consistently convert their project pipeline into sustainable net profitability.
Because they do not have the safety net of a multi-year backlog to fall back on if they stumble.
Precisely. As we saw vividly in Q1, they are highly vulnerable to physical disruptions like weather, and they rely on the unpredictable, episodic nature of high-margin emergency response revenue to juice their earnings. They have to prove to the market that their core recurring testing revenue is strong enough to smooth out that seasonal and episodic volatility and deliver consistent quarter-over-quarter earnings growth.
Right.
If they post another revenue miss, even if they blame the weather, the market's patience will wear incredibly thin.
That is a phenomenal balanced breakdown of the operational realities these two giants face. We have audited the books, checked the science, and defined the risks.
Yes, we have.
Now, before we wrap up today's deep dive, I want to leave you, the listener, with one final provocative thought to mull over. Something that builds on everything we've discussed today, but looks slightly over the horizon.
I like it.
Deep in the source material, almost as a footnote during an earnings call, there was a brief mention of data centers. Tetra Tech is currently running over 20 active feasibility assessments for data center developers.
It's a fascinating data point.
It really is. Now, we all know the narrative. Artificial intelligence is driving an unprecedented historic boom in data center construction. Everyone is focused on the chips, the GPUs, the energy grid.
Right.
But these massive AI data centers require almost incomprehensible amounts of water for cooling their server racks. We are talking millions of gallons a day.
It's massive.
In fact, over 15 states across the U.S. are currently considering strict legislative restrictions on data center development, not because of electricity, but purely due to water scarcity and local aquifer depletion.
Wow.
So here is the question for you to explore on your own. As the digital AI revolution collides headfirst with physical environmental limits, will environmental service firms like Tetra Tech and Onterris transition from being just compliance partners into the ultimate gatekeepers of global artificial intelligence?
It's a staggering paradigm shift. If you are a tech giant, you can buy all the silicon chips in the world. But if you can't get the complex environmental engineering permits to secure the water rights to cool those chips, you cannot run the AI.
Exactly.
The future of digital infrastructure may very well be dictated by the masters of physical water and soil.
The physical constraints always win in the end. And that is exactly why we do these deep dives, to find where the physical world meets the financial one, risk defined.
Portfolio protected.